Hatsun Agro, that one posted an operationally strong quarter. The gross margins improved while other expenses saw a dip. Mangalam, the stock has been on a tear. The management also was really confident when they spoke to us, but what's leading the stock higher?
Well, a couple of things, one thing was that it was a good operational performance. The second was, why was it a good operational performance despite a bit of a dip in the revenue? And we spoke with the management and they indicated that it was the commoditized part of the business which was weak this time, and that was on account of lower supply of milk, as a result of which they lost out on some 200 crore worth revenue opportunity. But then again, remember, because it is the commoditized part of the business, that did not have good margins as well. So the commoditized part of the business away, we had a revenue growth of 6.8%, but importantly, that led to a 30 basis points improvement in the gross margins, almost 110 basis points improvement in the gross margins year on year, and the EBITDA margin improved by around 220 basis points. Add to that, they also cut their expenses by about 5% other expenses that is, and as a result of which we had a 33% EBITDA growth and 54% net profit growth, despite a 7%, just a 7% growth in the revenue. If we added that 200 crores back, maybe the revenue growth would have been much higher, but it wouldn't have reflected so much on the margins. Now, on what the company said to us here on CNBC-TV18, they said that they focus on the consumer business, which was more profitable this time around in this quarter. And despite just a 7% revenue growth, they were confident of meeting double-digit growth for FY24. And that is because the second half of this year will see the return of that commodity business. So the first half will be operational expansion, whereas the second half will see revenues expand as well. Importantly, they've been diversifying from their geography as well. Tamil Nadu contributed about 65% to their revenues about 4 years ago, and now it's come down to around 50% and they intend to take their debt, which currently is around 1,500 crores, below 500 crores over the next 2 years. So that was the insight edge that we got. But from a dairy industry standpoint, it means that all the other dairy companies too will have lesser proportion of commoditized part in their business, and therefore they would have better margins. As a result of which we are seeing a gain in the likes of Dodla Dairy, Parag Milk, both of them spiking in trade on the back of Hatsun Agro's numbers, and more importantly, the management commentary of there being not a lot of commoditized part of the business. Dodla Dairy, which is again in the southern part of the country, is up around 14%. A 6% move is what we're seeing in Parag Milk as well. Let's actually listen into what Mr. Chandramohan said to us. He's the chairman of Hatsun Agro.
The milk situation is improving this quarter, and I believe things will start improving. But again, commodity business may take little more time for us to get in. We may get into double digit without any difficulty. But we are sure that this margin, whatever we are maintaining, it can only be better and not less. See, earlier probably Tamil Nadu used to be about 65% to 70% of our business. Last 4 years, gradually it has been coming down. And right now we can say that Tamil Nadu contributes 50% and the rest of the 50% comes from other states where we have entered earlier. Gradually the volumes are picking up. The next 2 years, my option could be it will be less than 500 crores debt. Because heavy depreciation is available, which is a cash inflow for us. And capacities are mostly built. So the debt could be in 2 years less than 500 crores in my opinion.
Okay, that's on Hatsun Agro. The other big mover in trade is